Hello and welcome. Before we start, please make sure to subscribe to our YouTube channel for news and updates. Oil prices play an important role in the global economy, directly influencing the cost of gasoline at the pump and indirectly impacting the prices of all goods and services. The price of oil has also been an important factor influencing global markets and inflation trends over the past few years. Historically, the relationship between oil and the economy is a two-way street. Low or stable oil prices stimulate the economy, and a growing economy increases the demand for oil, and vice versa. Oil is sensitive to geopolitics and economic growth. Although prices have fallen from their 2022 high, they have risen amid a spike in geopolitical tensions and the potential risk to oil supply. Oil prices are still roughly flat on the year and far below the 2022 peak of nearly $128. Oil prices can be volatile and difficult to predict, but fears that the conflict in the Middle East would send prices skyrocketing above $100 a barrel have so far not materialized. Geopolitics and growth tend to impact supply and demand, respectively, which can affect how long prices stay high and the resulting effects. The U.S. is the world's largest producer of oil and gas. Unlike in the mid-2000s, the U.S. is now the world's largest producer of crude oil. Advancements in exploration and drilling have increased output, allowing the industry to maintain high productivity levels. According to the Energy Information Administration, these improvements have been key to sustaining U.S. oil production growth, which now exceeds 13.2 million barrels per day. In the long run, world oil production is expected to outstrip demand over the next several years, according to the International Energy Agency. This is partly due to U.S. production, but it also reflects the changing dynamics of OPEC+. The group has extended production cuts into 2025 in order to maintain higher oil prices, although the incentives to renege on these commitments to gain market share are high among member countries. This has made the cartel less relevant over the past decade. A further spike in oil prices could act as a headwind to the economy and the soft landing the Fed is hoping to achieve. At the same time, there are many factors that make this less likely than in the past. Gas prices remain relatively low. Fortunately, gasoline prices remain far lower than their peak in 2022, when the average price per gallon of regular unleaded reached $5. This led the Department of Energy to begin releasing oil from the Strategic Petroleum Reserve, SPR, an emergency supply of crude maintained by the government. Since then, the government has been refilling the SPR at more attractive prices. From an investment perspective, navigating oil price fluctuations can be challenging, especially if they are the result of uncertain or troubling geopolitical developments. The performance of the energy sector during periods of market stress illustrates this point. In 2022, when the broader S&P 500 index was down 18%, and most sectors posted negative returns, the energy sector delivered a remarkable 66% gain. This followed a 55% return in 2021 for the sector, when the economy roared back after the pandemic. The bottom line? Oil prices have risen due to Middle East tensions, but remain well below their recent peaks. While oil can impact economic growth, investors should focus on maintaining broad sector exposures in their portfolios and avoid overreacting to daily headlines. Thank you for listening. For additional information, please visit mraadvisory.com.